Did you know that antivirus software like McAfee, cloud computing software like C3 Systems, and even major corporations such as EMC Corporation and Hilton Worldwide share a common trait? They are all or have been owned by private equity firms. Firms like Blackstone, KKR, Apollo, and many others have been acquiring major companies in almost unseen way. For instance, Blackstone, one of the world's largest private equity firms, manages over $1.1 trillion in assets under management. They have acquired more than 250 portfolio companies and thousands of real estate properties globally. Similarly, like KKR, another leading firm oversees approximately $638 billion in assets under management and has invested in hundreds of companies through its funds. Every year, private equity firms execute hundreds of billion-dollar acquisitions, taking control of companies across various sectors, and they hold trillions of dollars in what's known as dry powder, or capital ready to be deployed for sudden acquisitions, which can instantly shift entire industries and global markets. Also, this firm gain control over company system, debt, and key strategic decisions, directly impacting hundreds of thousands of jobs and even public services. Globally, all private equity firms combined hold roughly $5 trillion in cash. This is not their total company value or market capitalization. This is pure uninvested capital. To put that into perspective, the single pool of money accounts for 4% of the world's entire money flow. It is a staggering amount of capital waiting to be put to work. So now you know just how big and capital intensive private equity is. But to truly grasp its powers, we first need to understand exactly what private equity is. So private equity is simply firms that invest in assets or business that are not listed on the public stock market. And there are many different types of PE firms. Some invest in early stage of startups, which is called venture capital, but it's still part of private equity. Some focus on alternative assets like airports, toll roads, intellectual property rights, or carbon credits, providing liquidity for owners of assets that are difficult to sell in the regular market. Essentially, if something has value, there will be PE firms trying to make a deal out of it. There are even funds of funds that raise money to invest in other private equity funds. However, when politicians, journalists, and people on the internet talk about private equity, they are usually referring to buyout funds. These firms focus on acquiring entire companies and then restructuring and optimizing their operation to maximize profits. If any fund manager can run a successful buyout fund, that guy very likely becomes billionaire. So after establishing the firm, the next step in the buyout funds process is to find a deal. They do this by sourcing target company through their professional network, like investment banks and M&A consultants. Once they find an ideal target, they will conduct an initial screening. If they are highly interested, they will then ask for confidential documents under a non-disclosure agreement to perform a deeper analysis. This deeper analysis is called due diligence. It's a rigorous process that can take weeks or even months, where the firm meticulously examines the target's company financials, legal structure, management team, and operational health. After completing their research, the private equity firms will perform a detailed valuation and develop a comprehensive business plan before it makes a private investment offer to the company. If a deal finalized after a long period of negotiation, the work for the private equity firm is just beginning. They become actively involved in managing and optimizing the company to maximize its value. They can involve with operational optimization, such as cost cutting and improving efficiency, implementing new market strategies, or acquiring new business to expand the company, and also restructuring debt or modifying the financial structure and adjusting management, governance, and IT systems. This post-acquisition phase can take several years, but usually, after 4 to 7 years, if the company is performing well, the private equity firm will begin to consider an exit plan. This is when they will sell their stake and realize profit. The most common exit strategies are an initial public offering or IPO, a sale to another private equity firm known as secondary buyout, a sale to a larger corporation, and dividend recap. This entire process, from finding a target to exiting the investment, is how private equity firms make their fortunes. While the leveraged buyout or LBO is the most popular and feasible method, private equity firms also use other strategies such as growth equity, venture capital, and distress investing. So while the buyout process is complex, The results can be remarkable. Private equity activity itself may boost innovations, fuels growth, and can even save struggling companies. In effect, a study from Oxford University found that over 80 billionaires have made their wealth in the industry, with a significant number coming from technology sector. However, it is crucial to understand that the immense fortunes created by private equity often come with a heavy price. Many argue that the destructive impacts these firms can have on a country or even the global economy far outweigh the benefits. For all the innovation and wealth it creates, the business model of private equity rests on foundation of massive debt, a relentless focus on quick profits, and aggressive cost-cutting in the most vulnerable areas. This has led many to argue that, if left unchecked, private equity can be the cruelest form of capitalism in the modern economic structure. In theory, private equity is a great idea. Take investor money, buy a struggling company, restructure it, and then sell it for a profit. Sounds like nothing is wrong, right? But the problems begin when this theory meets reality. Leverage buyout promise of massive short-term returns creates immense pressure, and this pressure can corrupt the entire process. Leverage buyout shadows the company with so much debt that its primary goal shifts from producing a quality product to simply servicing its debt and the firm's goal of making money. Let's look at a real-world example. Marsh Supermarkets, founded in 1931, this was a well-established slow-growth grocery chain in Ohio. But in 2006, the company agreed to deal with the private equity firm for $325 million, and $237 million of them are debt, which is more than 17% is debt. The reason for the deal was simple. Sun Capital was not interested in selling groceries. They were interested in Marsh's valuable real estate portfolio. Under Sun Capital's control, the changes were swift and aggressive. They immediately cut management and sold the corporate jet, but their core strategy was more complex. They began selling off valuable store locations in a controversial tactic known as a sale-leaseback. These stores continued to operate as a Marsh Supermarkets, but they were now paying rent to Sun Capital partners, which collected the commissions. In a particularly telling move, even the corporate headquarters was sold for $28 million, leaving Marsh Supermarket with a 20-year lease contract that increased by 7% every 5 years. They further slashed costs by reducing product brand names, laying off staff, and outsourcing services. However, the leaner and more efficient Marsh turned out to be difficult to sell. In 2017, Marsh Supermarket finally went bankrupt after more than a decade under Sun Capital's control. While the private equity firm claimed a loss of about $500,000 from the investment, this was a misleading number because Sun Capital had already made a huge profit by collecting management fees and commissions from the sale of company assets. While the private equity firm made a huge profit by dismembering a legendary company, its actions also left employees with a massive hole in their pension funds and made it harder for local people to find groceries. We can say that this is the devastating effect of an industry that prioritizes its own profits above all else. And the story of Marsh Supermarket is not unique. This single case study highlights a broader trend, how private equity strategies have been linked to a decline in service quality in key sectors like retail and healthcare, all while contributing to a spike in company bankruptcies. A firm like PSSI, a sanitation company formerly owned by the private equity giant Blackstone, was caught employing at least 102 children between the ages of 13 and 17. And these children were working at the night shift in dangerous slaughterhouses, handling hazardous chemicals, and operating serious machinery. For this appalling violation, the firm was fined a mere $1.5 million, a pittance compared to their multi-billion-dollar income and debt. The case studies of Marsh and PSSI are just glimpses into a much larger and more alarming trend. On the statistics on private equity are truly horrifying. For every company that has a deal with private equity firm, the number of employees on average decreases by 12%, but the consequences can be far more tragic. Studies show that nursing homes acquired by a private equity firm face an 11% higher mortality rate, a staggering figure that translates to 1,000 more deaths every single year. And the aggressive use of debt in leveraged buyouts leads to even more instability. Companies acquired through this model have a 10 times higher chance of bankruptcy compared to their peers. With all of this in mind, let me ask you one question. If you had a business, would you take a deal with private equity firm or would you choose to stay a standalone company? Thank you for watching. Enjoy the silence.